topic from IFRS 9, okay? And I'm just making a very quick examples. I'm just trying to explain you that what happens in IFRS 9, sometimes they give you two different rates. And I'm just creating a small situation. A company issued bonds for USD 100 million at 5% coupon rate. And then they say the company has a cost of capital of 7%. This is possibly a second rate. Now, I request everybody to mute yourself so that I don't see your background noises. So sometimes they say the company has a cost of capital of 7%. It is one possibility. Or they say that the effective interest rate is 7%. So this is called EIR, okay? So this is EIR, and this is your weighted average cost of capital. And these both will be the same. I mean, either they tell you the company has a cost of capital of 7%, you do it, or they will tell you the effective interest rate is 7%, or they will say that, sometimes they will say that the present value, or, okay, no, let's not make it complicated. Effective interest rate, or they can say that the company has a discount rate of 7%. This is again, the discount rate, this is again the back. Now, what happens here? You receive 100 million today. So you need to understand first, let me just, instead of, you receive 100 million today, 100 million, the company has received cash. And then they promise to pay 5% for the next 5 years. Let's suppose that we are here, that it is a period of 5 years. It means that they are going to give 5%, 5%, 5%, 5%, 5% interest. So 5% means 5 million. So for the next 5 years, they will pay 5 million, and then they will return back 100 million again. Now, the question sometimes what students they ask, a company issued bonds for 5% for a period of 5 years. So which discount rates we are going to use? Now remember that this 5%, it has a very little role. It has a very little role. The role of this 5% is only to calculate how much of interest you have to pay in terms of dollars. Like, 5% into 100 million. So you are going to pay 5 million interest. That is all. That is all. This 5% is the coupon rate. Coupon rate means the interest rate, which you are going to give to the investors who have purchased your bonds. And 5% is only used for that person that, okay, 5% into 100 million, I'm going to pay out $5 million in cash. I'm going to pay out $5 million in cash. So you need to calculate only dollars here. Other than that, there is no real role for 5%. Now, all of your discounting, now what you are going to do, you need to do discounting in this case, and you also need to do compounding. Two things you are going to do, always remember, discounting and compounding. What do I mean by discounting and compounding here? It means that what we need to do, that first we need to record our liability today. So we need to see that, okay, we received, so we are the company, we received 100 million USD. So we need to record our liability, because at some point in time, when we are receiving this money, we are not receiving it for free, we have to give out something. So first we need to record our liability, and liability must be recorded in present value terms. Because, okay, I have to give back 100 million, but I'm not giving back 100 million tomorrow. I have to give back 100 million after 5 years. So I cannot say my liability is 100 million. I'm receiving 100, but my liability is not 100. My liability is, you see, this 5 million is my liability. This 5 million is my liability. This 5 million is my liability. This is my liability. So this 100 I receive cash today. This is my asset because I receive this cash. So 100 million straight comes to my bank account. This is my asset. In return of this asset, I have to return back, and these are my liabilities. And because the time period is not same, because 100 million comes today, but 5 and 5 and 5 I have to pay in future. So I need to find out their today's value because I have to record it today. I'm recording the liability today, but this 5 I have to pay after 1 year. This is after 2 years. This is after 3 years. So I need to find out their present values. Present values means that I need to do discounting. I need to discount them. And remember that discounting will not be done at 5%. Never. All discounting and compounding will be done on these percentages. Whether they give you in question, it is your EIR, effective interest rate, or they tell you that it is your VAT, or they tell you that it is your discount rate. So this 7% will be used for discounting. Okay. So what will happen? That you discount these numbers. And this is called discounting. Then second step will be that you will compound them. Like this is 100 million. I record it here. I find out the present value. Let's suppose that the present value of my liability, all these numbers, I discount all of them. I find out their present values, and it becomes 77 million. So this 77 million is my liability in my books. If it remains 77 in my books, I cannot pay 100 at the end of 5 years because you will only pay what you have in the books. So today my liability is recorded as 77 million, let's suppose. But it should not remain 77. It should increase to become 100 so that after 5 years I pay back. So this process what I was doing, now let me just make it a little bit more cleaner. So this process, when I was doing like this, finding out the present values, this process is called discounting. In discounting, I'm finding the present value, but then I have to compound it. Now this process is called compounding. The purpose of compounding is to make this 77 grow to 100. So in 1 year, the 77 will become 80. In second year, it becomes 85. Then it becomes 90. I don't know. Then it becomes 95, and then it becomes 100. This is called unbinding. Two words we used, unbinding or compounding. The purpose is that this 77, we make it equal to 100. It becomes 100 in my books. And let me show you the process now. What happens? Let's suppose that we understand that we have received the cash, which is 100, and our interest rate is 5%. So it means that our interest payment will be 5 million. Okay. And this 5 million you have to pay for next 5 years. And then you have also to pay 100 more. So how do you find out your present value? So let's call it that this is year 0, year 1, 2, and 3, and 4, and 5. Let me just remove 0. And I know that this is my liabilities. Okay. This is I need to pay. This is the amount. But this is the amount at the end of year 1. These are my years. Okay. These are the amounts. I have to pay 5555105. I need to find out the present value of this amount. For present value, I need my discount factor. Discount factor, I have to discount it. And which rate I should be using? Like I said, 7%. 7%. 5%, there is no role. 5% you only use to calculate your Interest payment, how much you have to pay cash? 5 billion. All of the discounting and compounding will be done on your effective interest rate or discount factor or cost of capital, whatever they use the language. All these things are same. I use the formula here for discount factor. Please see it carefully. The formula should be equals to sign. You can see it here on my formula bar. Now I'm writing down the formula. So I would say that equals to 1 divided by 1 plus this interest rate. I close the bracket and then I put the power sign, power 1, because this is first year discount rate. And then within this thing, I want 7% to remain constant, because if I copy paste the formula, it will give me errors. Because when you copy paste, the values, they shift. So I want that this 7%, which is my N10, this should not change. N10 should remain same. So what you can do, you can put a $sign. So on your keyboard, a $sign N and a $sign 10. You need to put this thing and it will lock the cell. It will lock the cell. If you don't want to put it manually, you can also use your F4, okay? You can take your cursor here, N10, and press F4. It will automatically lock the cell. Now when I copy paste the cells, you will see that everything is changing. Like if you see it is, L12 and N10. So L12 will become L13, L14, L15, but N10 remains same. So N10 I locked. These are my discount factors. And then I need to find out my present values. So it means that when I make a total, so what it gives me 91 million. Now let me just kind of little bit format this thing. I'll take it to 3 decimal places. So this 5 million, which you have to pay after 1 year, its value today, present value today is 4.6 million. This 5 million, which you have to pay after 2 years, its today's value is only 4.36 million. And this is 4.08 million. And this actually, if I make it 100 million, that 100 million which you receive today, and that 100 million when you return back after 5 years, this 100 million is actually only 71 million. So anyways, it was 105 because 100 principal plus 5 interest. So the total amount which you will have to pay is 91 million. Now, this is the point where you say that you split. Now, this type of financial instrument which you have given, it is called compound financial instrument. It is called compound financial instrument. And what the exam expects you, it says that split the equity and debt component. Now, split the equity and debt component. What does that mean? Now, you see that we record the double entry. We say debit cash. How much cash we receive today? We got 100 million cash today. And then we say credit liability. So what is the value of liability? You see that although you have to pay 125 million, you are going to pay back 125 million because you receive 100 now, and then you pay 5, 5, 5, 5, 5, and 100. So you are returning back 125 million. But the present value of that 125 million is only 91 million. It is only 91 million. 91.79, whatever. Let's call it 92. Now let me call it 92, let's suppose. So it looks like that I have to pay, okay, let me be very specific. 91.796, okay? And I'll make it 2 decimal places. So it means that I have to pay out only 91.8 million. So where is the remaining part? So the difference between this and this, 8.2, that is equity. That is called equity. So equity means this is the gain which you make. I explained this topic before as well. Listen, when you offered some investors that purchase my bonds, I will pay you 5%. They purchased these bonds at 5% because it suited them. They thought that it is giving a better return. If they put money in the bank is giving only 2%. And you are offering 5%. So investors will purchase your bonds. Investors are very happy. Investors are very happy because they make money out of that. If they put into bank, they get 2%. They purchase your bonds, they make 5%. They are very happy. You don't do business to make them happy. What are you making out of that? Why did you offer the bond? Their problem is solved. Investor is making 5%, investor is happy. Why are you offering the bond? Because you also make equity. For you, this is your gain. This is your benefit. This is the benefit of the company. Because and why this difference has happened? Because you are giving them 5%, but you are discounting at 7%. So this 2% is actually making this result. Because you have a discount rate, cost of capital 7%, but you are giving them, so it looks like that you are getting 7% benefit, whatever, they are getting 5%. So that is equity part, and it goes to equity, and it remains unchanged. It does not change. This 91 million will change. Now you need to make an amortized cost table. Amortized cost table. Now what happens? What is amortized cost? How much liability do I have? I have a liability of 91.8, right? But this liability I need to, if you remember that, now let me just show it again, that my liability today is 91.8. I have to pay after 5 years, 100. So I need to compound it. I need to unwind it, inflate it, so that in 5 years' time, it becomes 100. And this process should be done by 7%. So this 91.8 will increase by 7%. So let's see like this, that in year 1, so let me call it years 1. So in year 1, you have an opening liability of 91.8, okay? 91.8. And then you have interest, accrued. Let me call it accrued. You will accrue the interest. How much interest you are accruing? 7%, because compounding will be done by 7%. So you would say 91.8 into 7%. So your interest is 6.5426. And then you have interest payment. But you also pay the interest every year. How much you are paying interest every year? 5 million. So it looks like that beginning of the year, you have 91.8. You calculate the interest through this process. Through this process, you calculate 7%, and that is 6.426. 6.426 is your interest accrued, which you should pay, but you pay only 5. This is 7%, and this is 5%. My payment, this is my paid. This is what I actually paid to the investors. And then what happens? That closing amount, your closing liability, you make a total, and this is your closing liability.
Say it.
Yes, please.
Say just for clear understanding. Now we do the first step. We do the discounting.
Yes.
Now we are doing the compounding. Just that one. Another one. Say, for example, at year 4 or year 3, we revise our WACC.
No, that is not the case here. We are not going to discuss. It's not within scope of F7. You will be confused.
This one, which paper, Sayed?
Not here.
Not here. Okay, thanks.
So in second year, your opening liability is 93.26. Again, you will accrue your 7%. And this is this time if you see that the numbers have changed because your principal amount has changed. Before it was 6.43, now it is 6.53. Again, you pay 5 million because every year you are paying 5 million, and then you will continue this process. Okay. So if I continue this process, E26, this is E26, I make it F4. And this is like, so in the year 5, you see that you become exactly 100 million. So you started with 91 million and you come up to 100 million.
Sorry, sir, the front page, it's a bit it's small. I can't find the figures clearly.
Are you using mobile phone?
Yeah, mobile.
No, you should be on a computer because of course mobile screen is very short, small.
Okay.
So now what happened that the liability which you started at 91.8, you accrued your 7%, you paid out 5 million, and this is your closing liability. In next year, this 93, whichever was there, 93.23, this becomes the second year opening liability. You calculate 7%, you pay out 5, and remaining is 94. Third year, 94 plus 7% minus 5, 96. And fifth year end, you have a total liability of 100 million. Now, how do you record these transactions? See here, let's suppose that we issue this on, let's suppose, now I'm going to put the dates, okay? Let's suppose that we put it on 2016, let's suppose. 1st January 2016. By the way, we are in 21. We are here today is, I think, it's 29th of July 2021. So let's suppose that it is, okay, let me make it, 2018. So on 1st of January, 2018. On this particular date, when you receive the money, you record this transaction. This is your double entry. Okay, like this. Then on 31st of December 2018, end of first year, the first thing which you need to do, you need to accrue your interest. So you will say debit my finance cost, which is also called interest expense, finance cost or interest expense, and credit bond liability. And let me use the word here as credit bond liability. So this is the first year interest is 6.43, and I record this as my liability, that this is my liability. But actually what happens, you don't pay it. On 31st of December, you actually paid out 5 million. So you would say debit bond liability and credit your cash or bank, whatever, however you pay, 5 million and 5 million. So it looks like that I have 91.8, then I added 6.43, and then I subtracted, because you see that bond liability is here credit. Then you again made a credit, which means you are adding, and then you said bond liability is debit, which means you are paying out the bond liability. So you say minus 5. When you make a total, this is the same amount, 93.23, which you see here and which you see here. So these are the double entries. So if somebody asks you that how much interest will go to your P&L, to your profit and loss, this is what will go. Your finance cost, your interest expense. Listen, you are making a payment of 5, but you are booking an expense of 6.43. Expense is 6.43, but payment is only 5. And that is why this 1.43 is added up here to make it bigger. Now, you asked me, I actually explained the entire process. And this table which you call, this is called amortized cost. This thing is called amortized cost table. Amortized cost means the present value of the total liability plus the accrued interest at your effective interest rate minus the interest which you have paid out, 5% coupon rate. Now, if you pay attention, this compounding, I did it at 7%. Sorry, discounting, I did it at 7%. Compounding, I'm again doing it 7%. So there is no role for this 5%. The role of this 5% is only to find out how much money you have to pay out as annual interest, which is 5 million. That's all. My 5% has got only this role. Find out the interest payments. That's it. So you asked me a question that which interest rate to use. Interest rates will be only and only 5% for calculating interest payment, compounding and discounting all will be done with effective interest rate, cost of capital, discount rate, whatever they use the terminology. And you should remember that liability is increasing. Now, if you see my liability, this is my opening liability. Okay, this is nothing else. This is my opening liability. End of the beginning of year 1, liability was 91. End of year 1, liability was 93. Opening liability, this one, 91. Closing liability is 93. Liability will change and it will be converted to 100, so that when at the end of 5th year, these guys will come in and knock my door that you see, you sold the bonds today, 5 years have finished, we have come back. I say, how much do I owe you? And they say, we have bonds of 100 million in our hand. Did you receive your interest 5 million? They say, yes, we received interest every year. So thank you very much. I've given you 5 million interest. Now I have to give you back 100 million back. So I open my balance sheet, and in my balance sheet, 100 million is there. 100 million is in my balance sheet. I see my books. Do I have a liability of 100 million? And when I open the balance sheet, it shows me 100 million. So then I make a double entry at the end of 5th year, whatever it is, like 31st of December, I don't know, 2023, when 5 years will finish. This 100 million will be there. And then you would say debit, bond, liability, credit, bank, or cash, whatever, and that would be paid out 100. And this chapter is closed. This transaction, it started and it closed. But you should remember that throughout this process, this equity did not change. It was 8.2 at the beginning. It went to your balance sheet on equity portion, other components of equity, we call it. It is the money which, it is the benefit out of this five-year transaction. The investors are receiving this money, 5 million, they are happy. But the shareholders, they got this one, 8.2. This is their gain. Because out of this transaction, we received 100, we are paying back only 91.8. So 8.2, this is the gain, this is the benefit, which belongs to the shareholders. It is an equity, and it does not change. It remains 8.20. Any questions until here? Okay, Having asked one question that sometimes the question says that you are issuing the bonds for 100 million, but it says that redeemable at 10% premium. Yeah, Harleen, this is what you want to ask. So it means that you will receive, yes, you receive 100 today, and you have to pay back 110. So in that case, here we should have 110, right?
Yes, sir.
It should not make any problem at all. Everything is same, 100% same. Nothing will change. The only thing is that in last year you will say that I have to pay 5 and I have to pay 110. And then when you make this 110, the numbers will change. it becomes 95, and then you start your table with this number, and it becomes whatever 110. But there is something more I think I missed up here.
Ali, what about the amortization? The
What
amortization. I mean, of the premium or the discount. If I issue the bond of 90, the bond was issued for 90 million at the coupon rate. So I issue at a discount or.
No, first let me finish the premium, and then I'll come back to the other situation.
Okay.
So if you have to pay back at the return back at the premium, the entire process, again, you are giving 5%, so this remains same. Again, you will be discounting at 7%, so this remains same. The only difference will be that instead of 105 here, you should be adding, actually, in last year, you should be paying 5 and 110, 115, okay? So in last year, not 105, but 10 premium, you make it 115. And when you make it 115, and this number, you link it with your present value. So if you notice that before, I was putting 105, and present value liability was 91 million. But if it is 115, then present value of liability will be 98.9295, and now it becomes 110. You see, Arlen?
Yes, so my question will be like, what procedure, like we'll take it through OCI or PNL. So that was the procedure, like we have to look at the two criteria, SPPI criteria and...
No, that is now a different question. That is classification of financial assets. So here I'm not speaking any criteria. I'm only now telling you, because the question, it started with one issue, that 7% and 5%, where do we treat and how do we treat? So I'm not explaining the entire financial assets or criteria here first. I can explain, but that is a separate topic. The first topic which we are explaining here, that how to treat these values, how to calculate the amortized cost table. This is we have done. Now, if you ask a second question, now this first question I have explained, which somebody asked. What
yes,
you're asking now, please ask the question again.
Sir, I'm talking about the classification of financial assets. Like you said, for amortized cost,
This is amortized cost.
Yes, sir, this is amortized cost. But we will go through the amortized cost when there will be two criteria, like sole payment of principal and interest. And one other criteria was there. There will be a contractual cash flow, and the other
SPPI. There are two criterias, SPPI and held to maturity, or you are selling it or whatever.
Yes, sir. So how will we treat, like, suppose SPPI is sole payment of principal and interest? Does that mean also like it's the contractual cash flow? I wanted to
ask it is contractual cash flow. It is contractual cash flow.
Okay, sir. That is how to classify if you are issuing.
And there is no case of P&L and OCI because there are no gains and losses here. Gains and losses are always in fair value through OCI and P&L. In amortized cost, there are no gains and losses.
Yes, sir. I'm clear.
Good. Ahmed, now what was your question, please?
No, I mean amortization of discount.
Amortization of discount. Let's suppose that you are offering it, issuing it at not 100, but offering it at $90, for example.
90, yeah, or 95.
95. So this is the bond which you have to return back 100, but today you are receiving only 95, right?
Yeah.
So very simple. The same thing here, which you have to give back at 100. So the same table will come here, and I'll put it like this. And you are actually today you receive only 95, and then equity is 3.20. That's it. I mean the treatment remains same. Only the number will change. So if I receive cash today 100, I still have to pay 5555, and end of year I have to pay 100. No problem. My present value of liability is 91.8, but I receive cash only 95. So it means that my equity portion will be reduced. Rest of the process of discounting and compounding remains same. What goes to P&L, what goes to balance sheet remains same.
I think Sayed, the buyer will be in a different situation because he will create a discount.
He will have his own discount rates.
Yeah.
So we don't know about his discount rate. His discount rate will be less than 5%. That's why he has invested here.
Okay, thank you.